Another wild ride on Wall Street this week as stocks continued their October swings, with the Dow Jones Industrial Average at one point dropping below 16,000 for the first time in 8 months. So what's behind the latest volatility, and should American investors keep their seatbelts buckled? We're back with Dan Henninger, and Wall Street Journal assistant editorial page editor James Freeman also joins us. So Dan, what's your diagnosis?
Well, you know, Paul, it is fascinating that we have seen nothing like the volatility we had this week, where the Dow was going in the red, in the green all day long. And, you know, stock markets are pretty good at pricing events out there. And I don't think some of these things that are going on right now, like Islamic State in Iraq, Ebola, and so forth, could be causing that kind of volatility. Markets absorbed it. They knew those things were going on. I think it has to be something else. I like to point to the International Monetary Fund meetings last weekend in Washington, in which central bankers admitted they have run out of tools to stimulate growth in the United States, and that the United States has to lead if the world's going to grow again. The institution here that has been trying to do that is indeed the Federal Reserve. And the Federal Reserve keeps sending mixed signals on when it's going to get off the zero-bound interest rate policy. And even they say that we need something else. And that something else would be pro-growth policies from the White House and Congress, a tax policy, regulatory policy. None of that is happening. And so I think the stock markets have reached their own upper bound and are bouncing around trying to react to when the United States economic policy is going to enter a pro-growth phase.
James, a correction is supposed to be about 10% from a market peak. We aren't there yet. But is this decline in volatility signaling, in your mind, maybe slower growth to come?
Well, certainly we've gotten some bad news on that front lately. Germany and Europe.
Not in the U.S. so much as overseas.
Well, we got some bad U.S. news in terms of retail spending. Generally, I think the U.S. economy is grinding along. It's still growing. But we got some bad news overseas. Germany, as we mentioned, Europe, and China slowing down as well. But I think this is very healthy if central bankers are realizing finally that printing more money is not the cure and the path to economic prosperity. And
I think you're both optimists, because I think, in fact, the pressure, the political pressure, is going to build on the European Central Bank to follow the U.S. route here, and that the political systems over there don't want to make the reforms that we all know are necessary, that they know are necessary in labor markets and tax markets and in regulation. And then the Federal Reserve is basically signaling this week, look, if you get any slowdown overseas, we're not going to move up our interest rates at all, and it'll just delay the day that happens.
I'm not optimistic that Europe is going to reform its economies, that Southern Europe is going to fix what's wrong in terms of labor markets, where people don't want to hire anyone because you can't fire them. But I think there's a reason to be a little more optimistic potentially about a policy change in the U.S. If Republicans take the Senate, you probably have at least a pretty big break on the hyper-regulating we've seen in the last few years. I don't know how you can't be optimistic when you can see this continuing North American energy boom rolling out. This is what's giving, partly along with slowing global demand, this is what's giving us cheaper gasoline, cheaper oil. That's good for a lot of industries in the U.S.
And yet this week the administration effectively killed a merger of a U.S. company, AbbVie, overseas, an Irish company. They were going to take over an Irish company, and now their board is saying no because of the new rules on corporate tax policy.
Well, exactly. I mean, the tax policy, corporate tax rate in the United States remains the highest in the developed world, 35%. And Barack Obama could have had a cut in the corporate tax rate from his first term onward, but has refused to do it because his price for doing so is too high. And then you end up with the Treasury Department essentially shutting down this merger that you just described between two pharmaceutical companies and basically killing the tax inversion idea. As long as markets are watching this kind of activity from the Obama administration, I think they're going to fluctuate for a long time.